Hi, y'all. I'm John Rotanti, a portfolio manager at Bastion Fiduciary and one of the hosts of Rebellious Allocations, which is our Bastion Fiduciary podcast. And I'm joined by Todd Wenning. Todd is the founder of KNA Capital Management and the author of the book, Keeping Your Dividend Edge, and the author of the Flyover Stocks newsletter. Prior to founding KNA Capital, Todd was an equity analyst at The Motley Fool, at Vanguard, and at Ensemble Capital. And Todd was also the former head of the equity stewardship framework at Morningstar. While at Morningstar, he contributed to the book, Why Moats Matter. Todd also teaches corporate finance and ESG investing at the University of Dayton. Todd, welcome to the show.
John, thanks for having me.
Yeah, so I invited you on the show to discuss Old Dominion Freight Line, ticker ODFL, which is a stock that I own in the portfolio that I manage at Bastion Fiduciary, and a stock that you own in your client portfolios as well. I'm just going to give a few basic company statistics so listeners can get an idea of the size and scale of the business. Old Dominion has a market cap of about $32 billion, I think, and very little debt. So its enterprise value is also about $32 billion. In the last 12 months, it generated revenue of about $5.6 billion and net income of nearly $1.1 billion. So let's get right into these questions, Todd. Please give us a brief description of Old Dominion. What does it do?
Sure. Old Dominion has a really interesting backstory. It was founded in 1934 by a husband and wife, Earl and Lillian Congdon. And what I find really fascinating about this story is that Lillian, the wife, was the one who really started the company and saw it through. So from the beginning, it's had this very unique setup where a female founded a trucking company, which is extremely rare in the industry. So it was founded in Richmond, Virginia, hence the Old Dominion. And that goes, and it's since moved headquarters to North Carolina, but it started in Virginia. So hence the Old Dominion. And they ran one truck from Richmond to Norfolk, Virginia and back. And so this idea that they collect items to ship from Richmond, bring it to Norfolk, and then back from Norfolk to Richmond. And then from there, they just expanded. And since then, the Congdon family has continued to play a very big role. They're no longer the CEO of, there's no longer a Congdon as the CEO of Old Dominion, but they remain the executive chairman. And there's another board member who's part of the family as well. So the Congdon family continues to own about 12% of the stock. So the family remains a very big part of the ODFL story. So they went from that one route and from Richmond to Norfolk to having over 260 service centers or kind of distribution facilities around the U.S. in 48 states. So it's really expanded quite a bit over that 100 years or so.
Yeah, that founding story, the high inside ownership, and that sort of owner-operator culture is definitely one of the things that attracted me to the business. So they are a less than truckload or LTL provider. What is the difference between LTL and truckload?
LTL is a very interesting niche in the trucking industry. So the North American trucking industry is about, I think it's close to about $1 trillion a year. And truckload, which is where you hire one truck to take your goods from point A to point B, is the largest part. I think it's about $600 billion. And the LTL space is about a 10th or 12th of that. So much, much smaller. And so what gets shipped on LTL falls somewhere between needing a full truckload and a parcel shipment. So parcel is like, I need to send a book somewhere, something small, you can send it through USPS. Truckload is, hey, I'm Procter & Gamble. I need to send a whole truckload of Pampers to the Walmart distribution center every single week. And that's what truckload is for. LTL is different because it has historically catered to industrial shipments. So let's say you're shipping a couple of engines somewhere. You don't need a whole truckload to do that, a whole freighter to do that. But you also can't send it by USPS or FedEx ground. You need to send it through less than truckload. And the way less than truckload works is that you have two sort of segments of the business. You have the pickup and delivery, or P&D, and you have line haul. So you have the pickup and delivery, the P&D, they go out to the region around the service center and collect and deliver items. And so they pick up items from a local area, they bring it to the service center, and those packages are separated and then sent in different directions. So there's a lot of breakdown of cargo, and they can ship things across the country by moving them between their service centers. And so that's the one of the benefits of that. It's typically cheaper for a shipper to use LTL when they don't need to use the entire truck.
So we're going to get into the specifics of Old Dominion in a moment, but putting Old Dominion aside for now, do you think that either LTL or truckload has a better business model?
LTL definitely has a better business model. The truckload business is huge and it's extremely fragmented. I forget the exact percentage, but it's a majority of the truckload businesses in the country have less than 10 trucks underneath. And I think the largest operator might be Knight Swift or CH Robinson. They have about 1% market share. So it's an extremely fragmented industry. And there's really no barrier to entry to being an owner operator. I mean, if you have your commercial license and the rates are good and you can get yourself a truck, you can start hauling items back and forth. So there's really little uh, barrier to entry in that space. So the economics are very cyclical. Some of the larger operators might have some low cost advantages, or if they're brokerages, having being able to make those connections, like a Landstar, for example. But LTL is a much different beast. It's changed a lot, and we'll talk about that, the industry. But today, about 75% of the industry's revenue comes from the top 10 players. So it's a lot more concentrated than the truckload businesses.
Have there been any big industry developments or inflection points or paradigm shifts for the LTL industry like we've seen in so many other industries? For example, home builders trying to transition to a more land light model coming out of the global financial crisis, or E&Ps shifting from a sort of drill baby drill strategy to more focus on return on invested capital, free cash flow generation, and then deploying that excess capital to shareholders. Or banks coming out of the global financial crisis, regulators forced them to operate with larger capital buffers and lower leverage ratios. Railroads deregulated in the 1880s. Have there been any of these big industry wide inflection points for LTL?
There have really been quite a few over the past 40, 50 years. So prior to 1980, when the Motor Carrier Act came out, which deregulated the industry, this industry was very highly regulated and the rates were set, and they were typically overcharging the shippers. So it really wasn't a good deal for shippers. And ODFL was actually in the forefront of moving towards a deregulated industry. They wanted a deregulated industry because they felt like the customer service that their customers were getting was not good. And so ODFL wanted to really focus on saying, hey, we believe we have a service advantage. You know, going back to the family focus that ODFL had for a long time, they wanted to be able to flex that advantage. And deregulation allowed them to do that. And even though deregulation really hurt their business for a good part of the 1980s, they continued to push through because they knew on the other side that they were going to come through by having the better quality offering. So that was one big thing. Deregulation changed the industry. Another was that you've moved significantly from a union-based workforce to a non-union-based workforce. So in 2002, about 45% of the labor force was union in the LTL space, and today it's about 15%. And a lot of that has to do with Yellow going bankrupt. They were a big union base, and there are still some large union present in the industry, but it's much smaller than it was before, and that created opportunities for better efficiency. And we can touch on that later, perhaps. But that's been one of the other big moves. The third big move is the on time, in full delivery demands from the retailers. So the industry I mentioned typically was historically industrial, and it increasingly became more retail focused. So today, about 30% of ODFL shipments are retail. So that's things going to like the Walmarts or Amazon. And that's changed things a little bit as well. But the retailers have increasingly demanded from their shippers on time in full deliveries. And so if you're a small business and you're shipping items to Walmart distribution center to be sold, they want things on time, in full, undamaged. And so that's really put a quality emphasis and prompt delivery emphasis on the industry. And so that's for some of the weaker hands to either get acquired or, in the case of Yellow, for example, go bankrupt. And then finally, there's this move, and it's the pricing change just happened in the industry in July 2025 to a density-based shipping pricing. So the NMFC is the National Motor Freight Carriers or classification system. And so this is a standard that kind of helps shippers and carriers understand what a fair rate is on their items. And so there's classifications that go all the way from large and dense to small and light and everywhere in between. So you kind of have a baseline of what your pricing should be, based on those metrics. And so if I'm shipping a series of dumbbells, for example, that falls under a certain class. Or I'm shipping a box of feathers, that goes under a different class. And so it kind of sets the tone for pricing. But historically, it was more weight based. So it would be based on if I was shipping dumbbells, for example, a 45-pound dumbbell. I would have not much differentiation between shipping a 45-pound box of feathers, but a 45-pound box of feathers would take up a lot bigger part of my truck than it would the weight. So they're moving more towards density-based pricing, which I think will be helpful for the carriers to get that pricing, especially as they shifted more towards retail. These are typically lighter but larger packages, and so having that density-based pricing will be a game changer, I think, and a positive to both shippers and carriers. But I think it will be a net positive for pricing in the LTL space. So that's a long answer for you, but there's been a lot of change.
Well, I spent a lot of time thinking about these big, paradigm shifts in an industry when I'm trying to really understand a business, where it's been and where it could go in the future. So I appreciate the thorough answer. You mentioned about 15% of the LTL industry is union. I believe Old Dominion is a non-union workforce.
Correct. As far as I know, they've never had a union-based workforce, and that really matters. When I've spoken with some industry folks who have worked in both settings, it's really a night and day type of scenario. Now, we haven't really gotten to the nitty-gritty of the service center operations yet, but suffice it to say that you really want efficient operations. You really want people who are there working to full productivity. And when you have union type of breaks, or the sort of infighting about who takes what job, that really slows things down. That reduces productivity. That reduces your margins that you can make in the industry. And so having that culture of non-union, but really taking care of your employees, I think that's a big part of it. I'm sure we'll touch on it with ODFL's family culture. And taking care of your employees leads to better quality, which reinforces their value proposition.
Absolutely. And we will definitely get into all of that. You mentioned, I think, 75% of LTL is controlled by the top 10 players. Can you talk a little bit more about the competitive environment? What is Old Dominion's market share? How does that compare to the other leading LTL players? Would you describe LTL as a consolidated or a fragmented industry? And how have those market shares trended over time?
It's become more consolidated over time. It's certainly, Yellow going bankrupt was a huge, I think that was about 10% of industry capacity just got shut down. So it was a big redistribution. And that's part of the reverberations that we're feeling today, which is all these LTL carriers, some of whom bought the old LTL service center or the Yellow service centers, trying to, figure out their market share. And so we're seeing a lot of volatility there. But in terms of the breakdown of the industry as it currently stands, FedEx Freight, which is due to be spun off next year, I believe in 2026 from FedEx, is about a 17% market share, followed by Old Dominion, about 12%. And then there's a couple others like ArcBest, Saia, XPO, which each have about mid-single digit market shares. And so it's a consolidated industry, but it would not likely fall under the purview of antitrust if one acquired the other.
All right, so let's talk about Old Dominion. How would you describe their business model? How does the service centers and that network density factor into their business model?
So if you look at the way they are set up versus their competitors, it's primarily a quality offering. So if you are really focused on getting your packages or your parcels, or not so much your parcels, that's the wrong language to use, but your shipment on time and undamaged, which is increasingly in demand, then you want to go with ODFL because that's their focus, on time and undamaged. And so if you look at the matrix versus other competitors based on servicing versus price, ODFL is very much in the premium offering, but they're also kind of fairly priced. They price for that quality, but it's not, you're not paying, first class rates, so to say, business class rates maybe, but it's a good solid value for what you're getting. And a lot of the competitors have historically competed on price, and the weaker hands have been particularly bad at that. There's high fixed costs in the industry, so you have to have shipments coming through. And if your key differentiator is price, if rates go down, you have to drop rates even lower, and you got to keep those rates coming in, or the shipments coming in to cover your fixed costs to keep your business going. ODFL has historically gone against those forces. So while the industry has been chasing freight in down markets like we're currently seeing, ODFL has held price because they say, hey, we want to get paid for the quality that we're providing to our customers. And so what they typically do is over time, they want a spread between the revenue per shipment and the cost per shipment of it's been about 200 basis points or so over the past 7 years. So the cost of shipment's gone up about 4.5%, and the revenue per shipment for ODFL has gone up about 6.5%. So about 200 basis point spread. And that's what they go back to their customers with when they want to do a rate increase. They say, hey, we are investing aggressively in trying to improve our network, trying to keep our the age of our trucks low so that we can ensure that your products will be delivered on time and undamaged. And one of the reasons why it makes sense for shippers to pay the higher premium for ODFL in a lot of cases is that the receivers, so let's say you're a Walmart or an Amazon or a Home Depot, if the shipment arrives damaged, then it's up to the shipper to compensate them for the damage. And a lot of times the damage cost can outweigh the cost of paying a little bit extra for ODFL. Now, a lot of these Home Depots and Walmarts and Amazons have what's called preferred carrier lists. And ODFL is, I can't think of an exception. They're always on the list. And so what happens there is the Walmarts and Home Depots will negotiate rates with ODFL, and they'll promote them as, to their shippers as, hey, you want to use one of these carriers to deliver your products. You can decide among them which one you think is the best rate, but just know that if something comes back damaged, we're still going to come back to you whether or not you use one of our preferred carriers or not. If you don't want to use one of our preferred carriers, there might be an additional penalty involved. So from ODFL's perspective, even though they're negotiating that price, and they may not be getting the price they would have maybe gotten if they had worked directly with the shipper, they are getting the volume. And again, the key is to cover those fixed costs. And so being on this preferred list is essential to ODFL and anybody else being a profitable LTL carrier.
Yeah, you've mentioned several times, the value they are providing, the value proposition is on time, undamaged.
Mm-hmm.
And they do this by investing in their trucks, investing in their service centers, having that non-union workforce, owner-operated culture. And there's an industry sort of scorecard. It's the Mastio, I think it's called. And Old Dominion has been, voted highest quality, I think 16 years in a row.
Right.
So it's being recognized.
Yes, it's being recognized, and that certainly helps them push in through the higher prices. And what typically happens, we talked about the NMFC rates, but ODFL will have a lot of additional things. So I think the vast majority of their products are shipped either next day or second day delivery. And so if you're shipping things from, say, Ocala, Florida to Spokane, Washington, that's not easy to do with a less than truckload. It's hard to do even with truckload. You're asking one person to drive your goods all the way across northwest in the country, and an ODFL can do that by moving their trucks between their different service centers and breaking down the shipments as fast as possible, getting them on another outbound truck, and getting them to your destination with a guaranteed time, whether I think it's either noon or 5 p.m. And so, having that reliability is very key. And so the demand for that type of service does fluctuate based on the economy. So if people are struggling, maybe they're just saying, hey, I'm willing to take the risk of some damage and go for a lower priced offer. Or if I don't have a need to get there next or second day, I can go with a different provider. But by and large, I mean, they are the gold standard for quality in the industry.
Yeah, definitely. So, Todd, you spend a lot of time analyzing competitive advantages, sometimes called moats, looking at both the width of the moat, narrow, wide, or none, and the trend of the moat, negative, positive, stable. You also write a lot about moats. So let's start with, do you think Old Dominion has a moat? And if so, what is the source or sources of that moat?
It's definitely a narrow moat, could be potentially wide. I think the reason I'm not convinced that it's wide is that there aren't multiple sources
Mhm.
of moat. So I think you can definitely make the case, and I do, that they have what I think is called a physical network effect by having these nodes. So if you just kind of think about the US map in your head and you think about 260 or so dots across the country and representing ODFL service centers, for each of those dots, you have emanating the pickup and delivery trucks, and they're going out to their, say, 100-mile radius, picking things up and delivering them. And then you've got line haul trucks who are taking the goods from service center to service center every single day. And it's just, you can visualize this network. And so as they add new nodes to a new region, that makes it easier and more cost effective for them to then service their customers and cut down on miles driven and become a more productive enterprise. And so there's this sort of flywheel effect where they can, if their quality is there, they can drive more volume, which reduce costs, which enable them to add more service centers. And so I think there is a network effect like effect, which then provides them with a productivity advantage. I think from a revenue per driver, so just an example, from a revenue per driver perspective, in 2017 they generated about $343,000 of revenue per driver. In 2024, this is in a freight recession, it increased to $521,000 revenue per driver.
Pretty impressive.
Yeah, and that has supported their margins. And I think for a long time, the concern was, hey, if shipments dry up like they have in the past couple of years, the operating margins that they've enjoyed in the COVID years and a couple, beyond, will revert to, low double digits.
Mhm.
But that's not happening, and the reason is that they are having enough shipments coming through each of these service centers to cover their fixed costs and keep their margins high. So it's important for that network density to be there. And so from a moat perspective, I don't think you can start an LTL today and be successful. I just don't think it's possible in a reasonable amount of time to compete against Old Dominion or maybe even some of the top other players. When you think about, first of all, it will cost billions of dollars to buy the real estate. And this is real estate that is hard to get,
Mhm.
because you want your service centers to be near population centers and near business activity. And a lot of those existing interests don't want to have an LTL service center with a couple hundred doors, down the street from it. They want, it's sort of a NIMBY effect,
Mhm.
right? And so ODFL has an advantage of being a legacy player because they typically buy the real estate versus some of their peers, which do a lot more leasing. And so they have control over their location, and they're not paying increasing rent every year, the better that they do. And so they have these locations close to activity, which is where they want to be. And so if I wanted to replicate that today, it'd be really, really hard. Trying to convince a local a board of commerce or a zoning board, hey, I'm a brand new LTL company and I want to set up a truck station here in your town. That would not go over so well.
Yeah.
And so it'd be really hard to build those things out from a real estate perspective. And then secondly, even if you do have the service centers, you need to have the demand, the local demand. And so if ODFL opens up a new area, the reputation precedes them. And so there are already people going, hey, I would love to work with ODFL. And so the salespeople there have a pretty easy job. They're not introducing ODFL for the first time. And so again, I just think it's really hard. And that's why I think there's a clear moat in that business. The intangible assets would be what I would argue is the secondary moat source, just the reputation that they have, which feeds into this flywheel and the advantage that they have.
So two main sources of moat there, sort of the geographic physical network affects moat, their geographic scale, and then the brand, the reputation they have They're on those preferred lists. Mastio 16 years in a row, known as the highest quality sort of LTL provider out there. You mentioned it. You don't think a new entrant could just come in and start up an LTL network. It takes a lot of capital, as you mentioned. I think Old Dominion is spending 10 to 15% of their revenue on CapEx, and they're investing countercyclically. They're investing during the down parts of these cycles so that they can take share, coming out the other side. I think over the last decade, Todd, Old Dominion took more market share than any other provider. And so they're trying to invest, during this down cycle right now so that they can hopefully repeat that, over the next decade by taking the most share going forward.
Yes, that is the game plan.
Yeah.
And the reason they're doing that is because the incremental margins coming out of a downswing are like 35, 40%.
Yeah.
And so that's really where you saw a step up in the past couple of downturns, where they came out and they just consolidated their gains. So it's not a fleeting gain when they take them, because a lot of these operators historically have had bad balance sheets, bad operational execution. And so it was a clear advantage to them and a clear opportunity to pick up scale when they could stay long-term focused. And because if they, for example, cut back during a downswing, like for example, during COVID, they did do some furloughs, but they didn't let people go and entirely. And so when things recovered, they got people back on really quickly. And that was, obviously one of the worst economic crises that we've had in the past 100 years. And they didn't let that many people go. They do downsize some of their flex employees when things get tight, but they bring them back on really, really quickly for that reason. And a lot of competitors, and if you're struggling financially and you, from a balance sheet perspective, and you have high fixed cost structure, it's really hard to compete with that. So ODFL, relative to its peers, has the best balance sheet, and the best productivity. And so it's really, so when we talk about their on time and their claims ratio, so they're on time over 99% of the time, and their claims ratios are 0.1%.
It's averages. I mean, some quarters it's close to zero.
Yeah. Close to zero. And I think one of the things I'm sure we'll touch on is that the competition has followed that playbook and has gotten better at their own claims ratio. So their claims ratios have gone down to say 0.3, 0.5%. But if you multiply that by the revenue base, it's still a big gap between, so 0.1 is not like, just a small percentage difference from the 0.3. It's 3 times less than the competitors. So it's a clear advantage that they still have.
Yeah. What about the moat trend? Stable, getting stronger, getting weaker? What do you think?
I think that's the huge question right now. That is the $1 billion question. So we've covered a couple different things. I think saying it's stable is sort of a cop out, because I think it's either getting wider or narrower, but and that is the debate. So given all this structural change that you've had, and now you have, I would say, a lot more rational competitors. So, TFI acquired UPS Freight, which was a long time laggard. XPO is now in the business, Brad Jacobs' company. So they're a lot smarter than they have been in the past. It's a much more disciplined industry than it has been historically. And so the question is, if there is this trend towards a rational oligopoly, where you have continued consolidation, more rational players, no kind of mavericks out there who are just kind of flying by the seat of their pants, what does that do to ODFL's quality advantage? Or is everybody just going to chase ODFL, or are people willing to stay at the lower price tier? And that's the big question. So you have seen some groups move towards ODFL space, but I do think the advantage is still there, and there will continue to be a need from a shipper's point of view, different price points. And so I think different groups will cater to those different price points. So I do think that the moat trend is slightly positive. So I wouldn't say that it's materially positive. There's not a clear material positive trend happening. I don't think it's correct to say that it's stable, because there's so much change happening.
Yeah.
But I think the bear case would be that ODFL's differentiation versus its peers is shrinking. And that's a fair observation to make. I just think that historically speaking, the evidence is on ODFL's side to maintain this differentiation across business cycles.
So speaking of differentiation, what is the source of their pricing power? I think earlier you said traditionally it's been about 200 basis points historically. What enables them to be able to have this long history of increasing prices up to offset inflation?
I think it's really just the track record and the reliability and the reputation they've built. I mean, a lot of these in industrial businesses, I think what gets underestimated sometimes is the power of relationships. And they're moving a lot of material, a lot of expensive material, long distances when damage and delays are just not an option. And so if you have these relationships with your local ODFL district manager, and they're able to deliver this again and again and again, it becomes an easier sales process to say, hey, look, I know our competitors are dropping price right now, but we are continuing to invest, as you mentioned, countercyclically, so that when times get better again, we're able to deliver exactly what you want, exactly on time. You don't have to worry about it. I mean, just to be able to put your goods on a ship on a truck and have it shipped, and knowing that it's going to get taken off the truck and put on another truck and moved and get there a second day and not have to worry about it is an incredible privilege. And so I think from that perspective, it makes sense. And also when you were talking about how the retailers and the receivers are increasingly fining shippers for not delivering things on time, that gives ODFL an opportunity to say, hey, yeah, we are charging a premium price, but again, you don't have to worry. And the claims ratio is extremely small. I mean, you're talking 10 cents for every $100 of revenue that they have on claims. I mean, it's a very, very small number. And so I think that peace of mind is worth something to shippers. Not all the time. Again, depends on the cycle, part of the cycle that we're in. And I think right now it's one of those cycles where shippers are thinking a little bit more, well, how can I save a little bit of money here? How can I save a little bit of money there with tariffs? I mean, we didn't even talk about tariffs yet, but tariffs are another thing that comes into this equation. So I think right now there's just a lot of moving parts in the space between the density-based pricing, between tariffs, and we also haven't talked about how truckload right is currently oversupplied. So truckload rates are lower, which may on the margin move some shipments that would have gone to LTL to truckload. So it's one of those markets
Taking
where
a little share currently
a
from
little
LTL.
share. Exactly. Yeah. So it's just not a great time right now to to have a clear picture of where the LTL space is going. And that's why I think the stock has been beaten up over the past couple of years, is just trying to figure out where things going next.
Yeah. Yeah. A lot of companies talk about pricing to value, pricing based on the value proposition they provide their customers. But I think that with ODFL, it's sort of easy to see on time, undamaged, clear value proposition.
Right.
Yeah. Which is another thing that I look for. So another topic near and dear to both of our hearts, I think, is corporate management and corporate governance. So how do you rate this management team?
It's a very good management team. I would say, if we think about it from, what does the perfect management team look like? They're excellent operators and they're excellent capital allocators. Those are two kind of roles that I think management plays. And I would say from a operational standpoint, ODFL is top of the class. I mean, that goes back to the Congdon family remaining a large part of the company from a cultural standpoint. I use a phrase called founder's pedigree, where even though the founder may not be with the company anymore, the culture that he, or in this case she, set for the company continues on through to today, whether it's next generation, 5 generations from now, it just continues. And I think that is a big part of the ODFL difference. And so from a management standpoint, a lot of the leaders, the CEO, CFO, COO, have been with ODFL for well over a decade. And those are the type of teams I want to back as well, because there's a lot of intrinsic motivation. It's not just about the paycheck. Paycheck's great. The stock benefits are, I'm sure, great, but they just live and breathe this stuff. And so if you were investing in an LTL where you had outside management coming in who maybe haven't been in the LTL space for that long, or maybe they came from private equity or something, right? It's just a completely different mindset, where these guys are going home thinking about how to improve my business every single night and every single morning. And so I think there is a ton of intrinsic motivation at ODFL. versus some of the peers. And I think that is a standout quality. The CEO, Marty Freeman, started in 2023. So there was some turnover in the management suite in 2023, which is kind of near the peak of the cycle. So it makes sense that some people wanted to say, "Hey, I'm going out on top."
Going out on top. Yeah.
Yeah. So Marty Freeman's been there since 2023. The CFO, Adam Satterfeld, has been there. He's been there for a long time. He's been there since 2004 at ODFL, and then 2016 as the CFO. And then Greg Plemons is the COO. He's been with the company since 1997. Been in the role since 2023. I think I mentioned the executive chairman, David Congdon, is part of the family. And there's another Congdon who's also in the board of directors.
Anything stand out to you, either negative or positive, regarding corporate governance?
The good thing is there's no red flags to me. And so that's really what I focus on with governance. There's been a lot of research showing that what you really want to look out for are the red flags, that bottom decile of governance that can really come back to bite you. And so I think ODFL has about a dozen board members. I think it's a dozen, and 9 of them are independent. You have the 2 Congdon family members and the former CEO on the board. So there's this balance between family and the independence. They have a lead independent director, so it kind of checks a lot of the boxes that you'd want to see from a governance perspective. I forgot to mention kind of a capital allocation. So I talked about their operational excellence. From a capital allocation standpoint, they do buybacks, they do dividends. I wouldn't say that they are opportunistic. So that's kind of the other half of the equation. So the great on operations, capital allocation, they're just they're doing fine. There's nothing stand out about them. So that's why I said, they're very good, borderline exemplary. So they are doing exactly what they're supposed to be doing, which is to continue to grow the business. And I think that's to the Congdon family's credit, because they could have easily said, "Hey, we're just going to milk this thing for cash flow." This is the 4th, I think, generation running the business, 3rd or 4th generation. And so at this point, there's no ties to the early days necessarily, or there's kind of weaker ties as we get further and further from the founding. And so they could have easily said, "Hey, we're just going to cut back in CapEx. We're going to cut back and just milk this thing for cash flow, pay ourselves a bunch of dividends, and maybe do a dual share class, protect the family's interests." And they don't do that. And so I think those are all positive things, and it speaks very well for the Congdon family and management that they are continuing to invest in this business, because they want to see it succeed over the next 10, 15 years and beyond.
Yeah, definitely. I think they initiated their regular quarterly dividend in 2017. They don't make acquisitions. I think the last acquisition was 2008. And as you said, they buy back stock. It's not necessarily opportunistic.
Yep. And to their credit, they were bidding on the yellow terminals, so the service centers. So when Yellow went bankrupt, they had a large number of terminals. I forget the exact number. It might have been about 100 or so that were up for grabs. And everybody kind of wanted them, right? Just adding new nodes to the network from existing. They were kind of in distress, and ODFL was bidding on them. They think they bid up to $1.5 billion. And what was happening was some of their competitors were just doing the prices right, where they're just adding $1 to the deal, trying to outpace them, because they didn't want ODFL to get the terminals.
Yeah.
And ODFL's management, to their credit, said, "Hey, we're done. We're not chasing
playing this game.
We're not playing this game. We don't really need the terminal. It'd be great to have the terminals, but we're not going to overpay for it." So I give them a ton of credit from that perspective, that they have that discipline not to chase and just pay whatever to get the terminals.
Anything else on corporate culture you want to discuss? You talked about, there's that founder's pedigree, non-union workforce. Anything else that you really want to hit on for corporate culture?
So if you follow ODFL for a while, you'll see they'll use this phrase OD family a lot. And from what I've gathered, I haven't worked there. I can't speak firsthand for the experience, but I've heard that it is accurate. I don't know how long ago this was, but there was a time where I think one of the Congdon family members who was CEO at the time could name every single person at the office, and know about their families and things. And so even though that's probably really hard to continue doing over time, knowing 20,000 people or so, it does speak to their care. And it's this idea that, hey, we're going to take care of our employees. I think there was, I've seen a couple stats how they've had a couple of millionaire employees who have bought the stock over the years and held on to it and done quite well. So they do really want to take care of their own. And again, that just reinforces the quality. If you have someone who's intrinsically and extrinsically motivated to work at a business, it's magic, especially in challenging times. And I think ODFL has that.
Today, as I look now, I think the stock's at $155 or so, which is down about 33% from its 52-week high of $233 per share. Touched on it briefly, but why do you think this is the case? The S&P 500, I don't know if it was earlier this week or late last week, I think hit an all-time high. Meanwhile, ODFL stock price is down a third from its high. Why do you think that is?
It's been a very difficult trucking recession over the past couple of years. We had a ton of pull forward demand during 2020, 2021. Yeah. Everybody was buying things for their house. I mean, just speaking for myself, we got treadmills and rowing machines and all sorts of things that were probably moved on LTL, right, for ODFL or somebody else. And then once that sort of binge stopped and we went back to life as it normally was, people were spending more on services. And so you had this snapback. And so there's a lot of capital put into the industry at that time when rates were really good, both on the truckload and less than truckload side. And now we're kind of feeling those after effects. So that's one layer of this, is that we had trucking overcapacity that's still kind of whittling its way down towards what would be considered normal from a supply standpoint. You also have just tariff issues to consider. There's a lot of uncertainty around that. So that's part of it as well. The PMI has been below 50, indicating manufacturing contraction for a couple of years. That doesn't help things as well. The weight per shipment at ODFL matters a lot when you're determining how much you're charging. And so that's consistently pricing lower. So the trend has been lower in terms of the weight. And so the industry has been kind of waiting for this recovery in weight per shipment, which is very reliant on an industrial upturn. So you're shipping heavier items versus, say, shipping a pallet of toys or something like that. You're shipping engines and metal products and things like that.
You mentioned the ISM manufacturing PMI. It was down 25 of 26 months in a row. And then it was up. That was through December of 2024. It was down 25 of 26 months. It was up very little. Above 50. So in expansion in January and February of this year. And everyone got excited. Finally we're bounced off the bottom. The industrial, recession, if you want to call it that, is 2.5 year industrial recession is finally gone. But now, that was January and February this year. But now it's been below 50 every month since February of this year. So it's almost like a head fake. It was up just January and February. So now if you look at the manufacturing PMI, I think it's been down and it's been in expansion above 50 in only 3 of the last 33 months. So it's been tough. And Old Dominion, I believe almost 60% of what they ship is industrial. So you can see that industrial recession has affected Old Dominion.
Yes, and based on the way the management team was talking in the quarters preceding this year, it seemed like they were kind of waiting for an industrial upturn around this time, and because of tariffs, because of other things, it just hasn't taken place yet. And that's been, I'm sure, incredibly frustrating for them. So I think markets hate uncertainty.
Yeah.
And John, you and I have talked about valuation before and how the majority of a company's value is in its terminal assumptions.
Absolutely.
Right. So 70, 80%. And if there's questions or uncertainty about those future cash flows, the value of the business should go down because that's just time value of money.
Yeah.
If you're charging a higher discount rate to account for the uncertainty. And that's where we are right now. And I think until we get a little bit more clarity about what market shares look like post this yellow bankruptcy and shakeup, and we have some more clarity on industrial demand, what that's going to look like over the next 5 years and beyond, I think the stock's just going to have a tough time. But as a long-term investor, I'm okay with that. These are the times historically where you'd want to buy ODFL because they're investing into a downturn and coming out with those high incremental margins and And then people make the mistake on the other side of normalizing those high margins. But the good thing about ODFL is that they have their sort of normalized margin has expanded over time.
Yes.
And the cycles kind of go around those higher normalized margins. They're not going back to, in my opinion, going back to where they were in, say, the early 2010s.
I agree. In this difficult part of the cycle, Old Dominion has generated net income margins, GAAP net income margins of around 20% for 4 consecutive years. Now, I know we're talking about shippers. We talk a lot about the operating ratio. They have a long-term goal of 70% on the operating ratio. But as you said, if they can drive more volume through that dense network they have, incremental margins, I think you said were 35 or 40%, and they've hit 70 before. They have hit 70 before. So it's doable. They just need some demand growth, is what management keeps saying.
Yes, I have to believe that as the economy continues to grow, hopefully, that will continue to push more shipments through ODFL. Just given their quality, their differentiation on that side of the equation, I just think it's a highly likely outcome that I think the current prices imply sort of flat shipments per warehouse over the next 5 years or so, and I just don't think that's going to be the case. I think assuming you're optimistic about the U.S. economy, I think you have to be optimistic about ODFL.
Yeah. Putting valuation aside, strictly, one of the things I look at is how are the company's fundamentals holding up during a really difficult part of the cycle?
Mm-hmm.
And in Old Dominion's case, they have very little debt on the balance sheet. They haven't had to lever up. They haven't had to take on a bunch of debt. And they're still generating operating So just for our listeners, shippers talk about operating ratio. It's most other industries talk about the operating margin. You can just do 1 minus the operating ratio to get the operating margin. And so a 70% operating ratio is like a 30% operating margin. Well, Old Dominion, even during this difficult part of the cycle, they're doing like 25% operating margins and like 25% returns on equity, thereabout. So even during a really difficult part, the business is strong. They're just not getting that growth.
Exactly. And that's from a cost control. When you think about the cyclicality of the business and the high fixed cost structure, the fact that they're still putting up these margins is very, very impressive. And then it speaks to how how productive they are on a per driver, per service center basis. It's just an extremely impressive operation.
Yeah. Looking forward, are there any meaningful long-term tailwinds that may drive organic growth in the industry once we sort of come out of this down cycle?
There's a couple. In thinking about reshoring, if that ever happens. We've talked about this for a long time. But if you have a renaissance in American manufacturing, that would obviously be a very strong tailwind for ODFL. I think one of the things that hasn't really been discussed yet, because it's probably maybe 5-10 years out, maybe, is the potential automation of the line haul routes. Mm-hmm. So again, these are routes where the driver goes from service center A to service center B every single day, taking things back and forth. It's the same route, same highways, everything is the same. You have to think that at some point that's a big part of their cost structure. So if you think about
and the driver, the labor doing the
labor,
yes.
Right? The labor is their biggest expense by far. They've done a great job reducing that as a percentage of revenue over time. But if you can greatly reduce the line haul wages and salaries, that would even go a longer way to improving their cost structure. Yeah. So that to me is a positive option that they're going to have. Now it's probably going to follow something.
You're referring to autonomous driving?
Autonomous.
Yeah, autonomous.
And perhaps not even, no driver altogether, but maybe one driver with a convoy of trucks behind him who are following the driver to the service center. It's a bit more complicated than that. Obviously, there's a whole bunch of things that have to occur in terms of regulations, driver safety, things like that. But it seems to be inevitable that we're getting to that point. And my guess is that at some point in the next 5 to 10 years, you'll start to see sort of a Waymo progression from starting in a dry, consistent climate, like Phoenix.
Sure.
So you might see the first automated line haul route between, say, Phoenix and Southern California somewhere.
Right.
And then eventually it'll expand as it gets proven out. And I think that would be, again, that would cater to ODFL's advantage because it already has these service centers in place.
Absolutely.
And so it's really hard, even if you said, hey, I'm going to get into autonomous trucking and I'm going to replicate this model, it's going to be even harder because you can't find the places to take your items because you don't own the service centers. So that advantage is still present, even if you have autonomous driving. So I think that could be kind of a longer term tailwind. Beyond that, I think from in terms of near term, it's really just the consumer confidence. Because again, this is retail.
Mm-hmm.
I have to think that if you have a better housing market, that would also be positive to ODFL because people, when they buy new houses, they buy fridges, they buy things that get shipped on LTL, and so that would also be positive. So it's just general U.S. economy strength, especially industrial, that I think could really turn the tide for growth in this industry.
Anything else that you want to mention with regards to Old Dominion, the business, the industry, the management, the moat, anything?
I think just in summary, I think everything's kind of synthesized. You just have this great operator who has a long-term focus, who has a long-term buy-in from the founding family, that there's intrinsic motivation to see this happen. It's not just about the money; it's about family pride and about making sure that this continues on for generations. Their corporate culture that is around that, with taking care of the OD family. All these things kind of playing together, and I think there's just sort of a self-reinforcing mechanism around ODFL that makes it second to none in the industry. And so, I think if you can take a long-term perspective, if you learn a little bit more about the LTL industry, I think you can begin to appreciate how ODFL operates a lot more and be able to invest countercyclically. So in times like this, when things look rough for the industry, you can have a little more confidence in ODFL's ability to see their way through it and thrive on the other side.
Todd Wenning, thank you so much for coming on the show. You have an invitation to come back anytime.
Thanks, John. Appreciate it.
Bastion Fiduciary is a fee-only SEC-registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions or personalized financial, tax, or legal advice. It does not constitute either explicitly or implicitly any provision of services or products by Bastion. All statements made regarding companies or securities are strictly beliefs and points of view held by Bastion or podcast guests, and are not endorsements or recommendations by Bastion to buy, sell, or hold any securities. Clients of Bastion or the host or guests of the podcast may maintain positions in the securities discussed in this podcast.